Hi, welcome back. This is the second segment of two in the chapter called Credit Source Choices and Debt. It's the seventh chapter in my online finance course. And I'm glad you're here. Thanks for coming back. We were talking in the first segment about, in Credit Source Choices and Debt, about what the best loans look like, the cost of credit, consumer debt. We looked at the components of consumer debt, mortgages and school loans and car loans. We talked about positive debt, when having debt is good, and if you have the right characteristics to take on debt, for example, that's enhancing your credit score, or you're paying your credit card balances in full, or you're saving the full amount, or some large amount towards your 401k. Now I want to talk about some investment thinking about debt. And the reason I called it this is because, again, many people say, well, all debt's bad. And my view is that certainly having no debt would be great. And if you could have no debt, but that means you live, in a tent, and don't go anywhere, and don't do anything, and don't get an education, and don't raise kids in safety and with some comfort, and don't give them experiences. If that's the life that you have to live to have no debt, well, I'm not sure that that's worth it. I think working hard and managing your wealth and your income so that taking on debt is practical and responsible is probably a better way. But you should know how to pay it back. You should understand how it works and be willing to renegotiate it, understand how to use debt, and in particular use it for important, valuable things. Now, I thought about a way to describe how debt can be used truly positively, like, not without risk, however. And I thought about calling this just investment thinking about debt. Leverage increases investment returns. Now, it also makes it riskier, right? Be an expert if you're using it this way. But, when you buy a home, right, you put down 20%. You borrow 80%. So let's say you're buying a $400,000 home. So you put down $80,000 and you borrow $320,000. And if the home goes up 10% in value to $440,000, now your equity is worth 20%. 400 is 80 is now $160,000. You've doubled your down payment because of the way mortgages work. It increases the returns on down payment and ongoing investments in your home too when you are leveraging your home. The more you borrow, if the value goes up, the more your returns are. I think I mentioned this in the earlier chapter, but I also teach graduate MBA financial statement analysis, and we know that return on equity for a company is composed of return on assets and financial leverage. And if you increase financial leverage in a company, you increase the return that's attributable to shareholders, return on equity. But you increase its risk. Now, if I'm looking at a senior executive team that has no debt in an industry where, all the other competitors have some debt, I think my management team is not working hard enough because, no debt means no worries. Don't want to over leverage the company, but some debt is important in a corporate situation. Certainly as an individual, you have the ability to choose to have none. But back to my point before, if you want to have a family that has no experiences, does nothing, all in the name of having no debt, I think better to work hard, earn a good income, save and invest properly, be practical, pragmatic, and prudent with your financial affairs, and take on debt for important and valuable things in a responsible way. Debt can be beneficial when borrowed funds have lower rates of interest than rates of return on invested funds. Now, I'm not telling you to go borrow at 3% and invest at 8% in the stock market, S&P 500 fund. We don't know for sure if the fund will return 8%, right? That's why it's best when the rates are long-term, not volatile, and when the rates are predictable, right? We need to know these things in order to make, and we call that arbitrage. When you borrow short and invest long. It's also a mismatch in assets, and that's where the opportunity comes from. So again, I'm not recommending these things, but I'm just saying that leverage can be beneficial. It increases risk, but if you are an expert and if you increase risk up to a level that's still prudent or practical. Home ownership. Most people in the United States will have a home mortgage. Homes are too expensive to buy for cash for most people. Some can. My former clients, many could, but not the average person. Now, how do you know? Let's now turn the other side of the coin. How do you know when you have debt problems? Well, if you're paying your bills late due to lack of funds, or if you're not paying your bills in full, or you're working out, payment plans or something like that. Sometimes that happens. But I'm just saying if this is the general course. Savings have to be used for required important purchases or payments instead of paying for it, out of income. If you have to use savings for important purchases, that could be a sign you're having some debt problems. If debt is used for unimportant items or things that could be delayed until your circumstances are better, things like an expensive car. I always wanted, big, fancy car, fast car, great looking car. Well, maybe wait until you're older, or wait until you make more money, or don't get it at all if you don't ever have the right circumstances. Entertainment items like a boat or extraordinary vacations. Now, I'm not against boats and I'm not against extraordinary vacations. I'm just suggesting that you be prudent about when you acquire these things, particularly if you're using debt to acquire them. If you can pay cash, that's different. And if you borrow to buy these things and you can afford them and your net worth and your income supports it, that's different too. If you don't have an emergency fund, if you're not contributing a meaningful annual amount to your qualified plans like your 401k and your IRA, if you're not growing your taxable investment assets, if these things aren't happening, that's a sign that you have debt problems. If your credit score is declining or poor, another sign. If you're paying only the minimum on your credit card balances, avoid, avoid, avoid. Don't do that, right? We talked about that. I mean, if you have to, and again, all these things can happen. You start a business, your kids go to college. I told my bad joke about the hair used to be brown, right? 8 straight years of private college. It would have been gray anyway, but it's a not so funny anymore joke. But my point is, it can happen. You have a medical setback, or things at work go badly for a year or two, or your industry is doing poorly, or you're having personal issues. Those things happen. The key is to, if you have to go through a period of time where you're paying the minimum on your credit card bills, do that. But then know that you want to start paying them down faster later. If you get a bonus or a raise, take the difference and save it, or use it to pay down debt, right? Be smart about how you handle your debt. So a reminder from the last chapter, disadvantages of credit, getting credit, or debt. Credit adds to the cost of the purchase because the financing cost increases the total price. It makes spending and impulse purchases too easy. Keeping up with the Joneses, too easy. I have to have a car like my neighbors. I want to have a pool like my neighbors. I'll take a vacation like my neighbors. Debt may become overwhelming, causing serious long-term financial problems, damage to family relationships, delay or failure to achieve your financial goals, and maybe worse, combined with other things that you can't plan, these risks that we talk about in the insurance section of this course, right? Risk is a loss that's unexpected. It's a negative outcome in a way that you couldn't have planned. You could have a medical issue, loss of a job, a business or professional reversal. These things happen to the best of people and to the worst too. But even to people who are prudent and managing their financial affairs properly, these things happen, and you have to get through them. What counts is not how many times you fall, right? It counts as how many times you get up. And so, but these things in combination with too much debt, overwhelming debt, can cause bankruptcy, severe negative personal, psychological, or professional impacts. If you have debt problems, you don't have to just roll up on a ball in a fetal position and give up. Consumer Credit Counseling Service provides debt counseling services for families and individuals with serious financial problems. Universities, military bases, credit unions, and other financial institutions, local, state, and federal organizations have credit and debt counseling services. Look for, like with anything, right? Look for reputable, low or no cost, and these are available, low or no cost counseling services with a track record of successful results. And counselors set up a debt management plan. The text, the terrific text that we use, the Kapoor text, calls it a DMP. It's a debt management plan. You pay the counselor and they pay your creditors. That way they serve as an intermediary and make sure it gets done. So there are answers if you find yourself in debt problems. Now, let's talk about the next situation, which would be a bankruptcy, when you can't discharge your debt and you have to make some sort of restructuring of your financial situation. So bankruptcy is a legal process that restarts a debtor who can't pay their debts in better financial standing. It restarts them to better financial standing by distributing all or some of their assets among their creditors. It's a last resort. Last resort. It severely damages your credit rating and your ability to borrow. It can last 7 or 10 years on your credit score, your credit rating. Now, it's more, I wouldn't say, it's more acceptable, I think, today than it used to be. Certainly in the corporate world. I mean, when I worked as an investment banker, we worked with people who did these packaged bankruptcies. They find companies that were struggling. They promote to them this idea of entering themselves into bankruptcy, and of course the investment bank would offer services related like advisory or lending or things like that, and then they would help the company emerge from bankruptcy. On the individual side, it's still a stigma, and there's still serious issue. If you can't get a car loan, every time you interview for a job, somebody sees your record that you've had a bankruptcy. If you're in a regulated industry like a financial advisor, that's going to impact your ability to work. So a bankruptcy is serious. This chart from the St. Louis Fed and credit slips shows bankruptcies in the United States. And in 2005, a bankruptcy bill was promulgated. I'm going to talk about that in the next slide. Notice that bankruptcies went up starting in 1985, peaked. This bankruptcy bill dropped them dramatically. It went back up again. I suspect that was because of the financial crisis. And then they've come down again since then. Bankruptcy Act of 2005 was promulgated under President Bush. He and others, I'm sure, that wrote. I'm not sure he wrote it, but he signed it. It includes financial management training, approved instructional course for debtors, bankruptcy districts required to maintain a list of credit counseling agencies, and courses in personal financial management. There are two types of bankruptcies, Chapter 7 and Chapter 13. This great image here from DaveRamsey.com describes the two. Chapter 7 is a liquidation. Chapter 13 is a reorganization. In general, it takes 4 to 6 months for the Chapter 7, 3 to 5 years, because it's like a restructuring or a reorganization or a negotiation. The Chapter 13, 3 to 5 years. But the Chapter 7 liquidation will stay on your credit report for 10 years. With the Chapter 13 reorganization will stay on your credit report for 7, right? And you can see some of the other details there. So bankruptcy is still a very serious thing. It's a last resort. It's more acceptable than it was. I've known some people that have declared bankruptcy and restructured, and they've moved on, but they've had some serious issues as they've gone ahead with their life. So it should be avoided at all costs, if possible. So this has been the second segment of the chapter called Credit Source Choices and Debt. I'm Tom Mihawk. Thanks for listening. I'll be back with the next chapter, so look for that one soon at YouTube. And you can find me at tommihawk.com, YouTube channel, at Resume Optimization, at Instagram and Twitter, and my new book, Optimizing Your Resume, available at Amazon now. Thank you for watching, and I'll see you at the next chapter soon.